people like to bring up the early 2000s with a tech bubble and everything like that. Do you see parallels to that? That ended spectacularly.
It did. It certainly did. That's where I cut my teeth as an investor. Was in the tech bubble, investing in cash right near the top, and then pulling my money out of cash and buying stocks when stocks had gone down 30%, thinking it was a great
Hmm.
deal,
Yeah.
which it was not a great deal. As a young investor,
Hmm.
the sort of bubble type dynamics that existed there, like it's pretty different today. Like the companies that are, valuations are elevated. That's certainly true. And they're elevated relative to bond yields. But there's not the sort of excesses that existed in that time frame. I mean, you know, believe it or not, whatever, Nvidia's got the earnings it's got, or at least, it's printing certain earnings, and if they are to be believed, they're pretty good. And the same is true with, other big tech firms or, other top companies. These are companies that are generating profits. The other thing that's interesting is, if you go back to that period, the tech period, a lot of the economic activity was basically borrowing finance. Like a lot of companies were borrowing a lot to invest in, tech infrastructure and things like that, rather than investing on a free cash flow. And that's pretty different today too, where we have, business borrowing is basically at recession like lows, and
Hmm.
companies that want to borrow and do investment in AI or whatever else they want to do are mostly doing that out of free cash flow. And so
Hmm.
that's just like a much more sustainable environment, much more plausible environment. It doesn't mean that Nvidia at 1100 is a great deal or will give you a great return over the next, 20 years, given the current valuations. All it means is like the sort of acute downturn, self-reinforcing downturn dynamic that existed back in the tech bust, boom and bust, is probably not going to be present in this period.
Yeah. Yeah. I mean, to your point, I mean, NVIDIA has not just earnings, but they have, a full order book, right? And every quarter they blow away what the already raised guidance was. And the dot com, some of these companies that came public in the early 2000s, forget earnings. I don't even think they had revenues, right?
Yeah, I mean, yeah, it's hard. I think people forget how how crazy it was
Yeah.
in the dot com period. Crazy. I mean, the prices went up a lot, but probably more importantly, crazy in the sense of there are a bunch of companies that essentially had no earning potential at all.
Right.
Mostly what we do with those companies today is we put them into the venture pipeline and they die by the time that they get to the IPO world. And, versus back then, companies were IPOing very early on no revenue and a lot of hope.
Yeah, yeah, those were the days. Yeah. Hopefully we won't see that again. But yeah. So what is driving this if it's not credit expansion? Is it the consumer? Is it tech? All the above?
Yeah, well, I think that the story is a bit of it's a bit old timey in the sense of if people earn income and they spend it, that's a sustainable thing.
Mm.
And I think people often will say, well, then there's no price, there's no price wage spiral. It's like, yeah, of course there's no price wage spiral in terms of what's going on right now. It's much sort of simpler than that. Like if you study sort of toy economies, one of my favorites is studying the POW camp economies
Mm.
of World War II. This type of dynamic that we're seeing today is actually very similar to what would exist there, which is that cigarettes were their money, and people would earn income, cigarette income, by, let's say, they provide a service. One person would cut hair, one person would make coffee, one person would make tea, one person was a cobbler. And how is it possible that economic activity occurred when, essentially the money supply was fixed and there was no credit? And the answer is people's income, right?
Hmm.
Which is, the guy cut the hair and got his cigarettes and then went to the cobbler and got his shoes fixed, and the cobbler got a cup of coffee, and that was someone's income. And that's basically how it works. And it doesn't mean there's a spiral, it doesn't mean inflation's out of control. It just means there's a functioning economy where that transition of one person's spending becomes another person's income
Right.
is a very sustainable dynamic that can play out through time.
Mm. Yeah, and the American consumer in particular has been very robust, going back to COVID, and keep spending more. The numbers keep going up. If you look at retail sales, what do you make of? There's been some. some stories in the media and elsewhere, social media, about the they've been citing some earnings and McDonald's and Starbucks especially about how this is an indication of slowing consumer spending. And actually today I just saw I've my counter argument to that has been that the travel industry is doing great, but just now I saw that American Airlines is talking about a slowdown. So uh, anyway, what do you make of all that? Citing those type of things that look kind of anecdotal, but or maybe even company specific.
Yeah, I often find it hard. McDonald's feels like a huge company or whatever, but like, it's not that big a deal. At an economy-wide level, it's not that big a deal. Like, the number of haircuts in the economy matters more than McDonald's. And we're not like, going over to Supercuts and checking and doing anecdotal studies of how many people are in the chairs.
Maybe we should.
Yeah, and maybe we should. And I think it really comes down to that. That's why you really do have to look at this sort of stuff on a top-down basis. I think one of the challenge for a long time, for many cycles, there was sort of this natural ordering, which is like, you saw certain sectors, start to weaken, and then that leads to the next sector, and the next sector, and the next sector. And part of the reason why that was because when you had a credit-driven economy, the most credit-sensitive sector started to slow, which was an indication that overall credit was likely to slow, which then created the second and third order consequences in the economy. And so people sort of got that. I mean, it's the reason why do people look at ISM manufacturing? It's uncorrelated to actual manufacturing activity. It's because for a period of time, the survey was more correlated to manufacturing activity, and it led because, spending on big ticket goods financed by credit was an early sign of what the overall economy looked like. And so a lot of folks, if you just like sort of engage, if you just look at how people are engaged with data and information, is they're looking for the thing that is the leading thing. And in an income-driven cycle, the leading thing is actually counterintuitively the income, not the spending, right? So if you have the income, then you have the income to spend, and distortions in terms of the mix of what you spend on can often be more important for any idiosyncratic line item than the aggregate spending dynamic. And so if you want to understand how people are going to spend in aggregate at the economy-wide level, you have to understand the income because they're spending out of their income. And then how it exactly, whether they go to, I don't know, McDonald's or Subway or, take a flight on American Airlines or whatever, that just comes down to the particular preferences that they have in terms of their spending mix. And, I'd say on top of it, I think a lot of people, if American Airlines came out and said, things are going to be largely consistent with what we expected, like no one would pick up that story too, right? So naturally people are trying to find weakening parts of the economy, and they think because they're trying to get a lead, and that idea of a lead isn't really working. It's more just a composition mix.